recording. All right, I think I'm all set. So, yeah, a few things I wanted to go over today. I can definitely go through some of my setups and pairs. I might save that for the end. Because one thing I did want to talk about is market expectations a little bit. And we'll take a look at some data from a trader that I've done my research into, my due diligence. He has plenty of credentials. And it's just something that I think is important because lately, obviously, I even mentioned it earlier this morning. I talked a little bit about market expectations and I guess the time frame behind it, because I will say Simple Markets has been open for about 5 months now, and some of the progress from you guys is more significant than I had in 3 years. So I do want to really push that point across, because for those of you that don't know, Andre was my first trading partner, and him and I started trading probably nearly 6 years ago now. I'm not even sure at this point. Um, but him and I were trading partners, and I guess I'll talk a little bit more about like my specific story. So I started as a retail trader, and I was actually with IML Academy, which for those of you that don't know, it's a very big pyramid scheme. I don't want to call it a complete scam. It's essentially a complete scam though, where mentors essentially bank on the idea that you're going to stay longer because they're not properly educating you. They would take your money and essentially they would teach you how to market to other friends and family and get them to buy in. And then the more people that you convince to buy their program, the more money you would get from the program. It's essentially affiliate marketing, but it's also a pyramid scheme at the end of the day. They ended up getting hit with a bunch of lawsuits as well because that model is very, very borderline illegal. But when it comes to the trading education there, it was just very pathetic. I was not taught anything about, I will say I came out of there with risk management. That's about all I learned properly. When it came down to understanding the markets are probabilistic, when it came down to understanding how to properly manage trades or even enter the markets or how to read them consistently, there was nothing about a trading plan that you should have any written rules. So it was a very rough start for me. And I guess a bit of a funnier story here is probably week one, I opened an account with Awanda, the brokerage. I think I put $500 in, and I took a setup. It was a head and shoulders pattern. And I actually at the time traded with another buddy. And me and him are messaging each other about this setup and how it's the most picture perfect head and shoulders lined up with the so and so Fibonacci, daily time frame inside one of our harmonic patterns, all this crazy shit. And it was essentially the picture perfect setup. It was, in my eyes, back at the time, not understanding probabilities, it was a 100% guaranteed win, this trade. So I went and threw on my order. It was $500 in the account, and I think I risked $100. Obviously, not understanding risk management at the time as well, because that's about 20% of my whole account. And what ended up happening, let's just, as an example, say I entered here, and my stop loss was at the relative high or whatever. I know at the time I didn't put it at the highs. I think the stop loss was something Fibonacci related up here. But regardless, price started working its way back. I expected bearish movement. And as price was moving back, and in my mind, this 100% probability trade, I kept grabbing my stop loss, dragging it more. I woke up the next day because this was a very high time frame. I didn't quite understand low time frames. Price came up a little higher. I got scared, so I moved my stop loss up a little more. And, of course, as the story goes with a million other traders you've probably heard with similar stories, I think I got taken out for like $280 worth of my account, which is half of my $500 I deposited. My 100% probability trade started leading me to questioning my mentors, wondering what the fuck happened. Everything, I followed everything they said. And it was kind of my first wake-up call, I guess, in trading. So that is actually, for a very long time, the only money that I lost to the markets, with the exception of prop firm evaluations, which come a little bit much further down the line, which I do think is another important point as well. I know some people just keep throwing money at the markets and try to make something stick. But that was my first about 4 months as a trader. After that, I moved into the SMC space very early on when it was kind of still budding in the YouTube space. And I had a mentor, and I actually joined a community where I met Andre. So Andre and I very quickly became trading partners, just worked on developing a trading plan on our own. But I will say about the first year that we knew each other, our mentor that we had, aka he was a guru at the end of the day, didn't tell us that a trading plan was like what it even was. And it's because he didn't really quite understand what it was. So for the first year, I'm trading the markets almost aimlessly, had no plan. I did start to kind of understand risk management a little bit better at this point because of IML. So I knew I should be risking like 1% of my account. But when it comes to my actual expectations of what a trading plan should be, I had no idea. I thought a trading plan was read the chart and enter. I didn't realize that there was rules. There's a mechanical versus a discretionary side to these things. So I didn't quite get that for about my first year. And then after that full year, Andre and I started realizing, okay, we need a written trading plan. So we dove into this very unrealistic way of trading, and that was the 1 minute time frame, utilizing 15-minute zones, utilizing a 4 hour bias, and utilizing a weekly bias. It was just an absolutely ridiculous multitude of time frames that came into confluence for your once in a blue moon trade. And honestly, it took probably 2.5 years for Andre and I to really gain consistency with this trading plan because we have talked about it before, but almost anything can work in these markets, literally almost anything. And, we took on something that was so ridiculous, this 1 minute time frame scalping, and eventually with years of hammering this strategy down, we were able to kind of nail it to a point where we were relatively consistent and able to get funded. Now keep in mind this is 3 years into my trading journey at this point, which is another thing I want to drive home because I hate to say it, but a lot of you guys here who are within your first 5 months, 4 months of SMC or trading in general, there's still a lot of learning process to be done. So I don't want you to get down on yourselves when you have these negative months or you're not doing so well at a certain point in the markets. It's completely normal. And to be honest, I feel like leveraging the community and people around you as guidance or at least a support system is extremely important because Andre and I only had each other for 3 years of just getting the shit kicked out of us. I mean, another funny story similar to my first one is I did a 10K challenge on my own. This was right when I like kind of met Andre. So this was on my own, and I came within 0.04% of passing. And honestly, out of pure luck, at the end of the day, I really didn't understand what I was doing. And this is another thing I want to drive home to. It is perfectly reasonable to win a challenge through luck because, as I mentioned, almost anything in the markets can work. If you have a solid period of, I think I was risking 2%. I just had one good reaction on a trade and was closed out at like 7.6%. It was 0.4% or 0.04, I can't remember, away from passing. So my idea was, okay, I'm going to take a trade like this. So if the market was here and I expected it to come and take out this market low, my idea was, okay, I'll just enter here with a nice fat stop loss because I only need 0.4%. And honestly, it was even worse than this, to be quite honest with you. It probably looked something a little more like this, and the market might have been down here and expecting it to come take this low. And so I was like, okay, I only need 0.4%. So I'll just do something like this. And obviously, it's more likely to go and run the low. And I opened that position, and immediately, price just started absolutely skyrocketing. And I tell this story as well because I just want you guys to be able to laugh not only at me but understand there's so many levels to trading. It's not something that at face value you're going to kick it right away and start doing amazing. There's so many goofy stories, so many terrible ones that I have throughout my journey that, someone DM'd me this week kind of asking a little bit more about my journey. And I just want to explain that 3 years was my journey to even relatively consistent profitability, but funding. And even when I did get funded for the first time on that 1 minute time frame, there was multitudes of years of learning after that I began to realize, okay, I don't like the 1 minute time frame. I'm going to scale up to the 15 minute. Did that for about a year, and then said, you know what? I'd like an even more passive approach. Went to the 4 hour, been doing that for about a year and a half now. And that just that consistent kind of scaling and learning is inevitable in the markets. Even 2 years from now, maybe I'll learn something different that I, eventually shift into. But I will say, even my first time getting funded, I did get a payout or two and then blew the account. Still didn't understand quite what I was doing. Had to go back in, get funded again. So, it's not a clean journey. Some people think trading is like, you start here and you're just going to consistently go up and up and up. My journey looked more something like this: a great win, followed by like crash and stuck in confusion for like 3 months. Then maybe like started getting the hang of things again, followed by like blowing the account and then back down here and stuck again. Like, trading is not a clean journey. But obviously, when you look at the grand scheme of things, you should be relatively progressing over time, and it's going to take patience as well. Sorry, I want to make sure I'm not getting messages here that I'm missing. But, it is one of those things where I don't want you guys to be too hard on yourselves after a few months. I might have time for backtesting, Luke, this session, but I do want to go over kind of going back to expectations. What I talked about here, I want to show a trader, and this is actually the top all-time record holder for the most times listed on the FTMO Leaderboard, and this is published on their page as well. I've done plenty of research into this guy in the past, so I do just kind of want to show him from the market expectation standpoint. He has 2 track records here. This is his most recent post. This is essentially verification that his audited brokerage verified his statements, that they are true. And audited, for those of you that don't know, means that your track record is tracked by a company who does it professionally and it can't be tampered with, as well as in a public platform. So this is the track record, and keep in mind, this is the #1 trader for FTMO when it comes to consistency. I do want to mention as well, don't sit here and take the #1 trader as the guy who made 400,000% returns in a month. I'm sure there's people who gamble away their funded accounts like that. But I do want to break it down from a consistency standpoint of, #1, he is a swing trader like most of us here. #2, notice the amount of months here where no income was made. So the key thing here is the patience, of course, that this involved. And then I think, he doesn't have his MyFX book on this one. We'll look at it on another page. But here, the SEC, Securities Exchange Committee, .gov, obviously an audited platform. And basically, I just want to go through his percentages. I want to talk about the consistency of it. So you're seeing very low percentages here. I'm sure he uses a relatively tame risk compared to some of us. So I'm sure he's not using 1% total risk on these accounts, especially when he has, I believe it's 2 point something million assets under management. But overall, small gains in January, small gains in February, nothing for a 2-month period, followed by relatively similar gains in May and June, fantastic month in July, another great month in August, and then followed by 4 whole months where he made no income. This is something I want to show because obviously net at the end of the year, 20.5% is fantastic gains, and that was for 2024. So I've mistaken myself. These 4 months has not been traded yet. But in 2023, you're kind of seeing the same idea where the first 2 months he didn't make any income. And I do want to mention this could even be from not trading. I don't want you guys to think, oh, he made no income, but he hopped on the charts every single day. In most of these cases, and most of the traders that I know that are on a higher platform like this guy I'm showing you, they could take 2 months off and be perfectly comfortable with it. He could even be loosely looking at positions for these 2 months and maybe even missing trades because I know a little bit about his strategy and how very passive it is. So he does tend to miss trades for long periods of time because he works on such a large scale. But he makes about 0.83% in March, a great month in April, a great month in May, followed by some, smaller gains in June, and then these 3 months in a row of some relatively tame returns and netting 21.3% in a year. Now, the things to mostly focus on here is, of course, there's the months with no income that some people look at and they have a heart attack because they're trying to live off trading. The other thing I want to show is his ability to manage drawdown as a whole. So this is his track record on an A book firm, which for those of you that don't know is direct to market. Um, and his track record, this is my FX book. I can just kind of tell from the platform here, but he made 27.73% returns. His absolute gain is 19.4. I believe that takes into account things like interest. And then monthly, he averaged about 2.11%, which, do not get me wrong, is fantastic returns. And some people also have this expectation a bit wrong. They're looking to blow the S&P 500 or the markets out of the water when it comes to their trading. Realistically speaking, someone like him on a bit of a smaller account could easily double his returns by increasing risk, depending on his strategy. We've seen things like this happen with Mark Douglas, or sorry, not Mark Douglas, Larry Williams, who is a trader of similar statistics actually, but what he does is increases risk on smaller accounts to achieve those greater gains. So simply doubling his risk here would net him 54% in a year, which is astronomical. But the only reason he can do this, keep in mind, is because he manages drawdown so well, and he would only achieve about 5.4% drawdown if he were to double his risk like that. And the key to understand here is, number one, he's not destroying the S&P 500. He's relatively on par with it actually for this year. I believe the S&P is up 27% this year. But the other thing to keep in mind is the drawdown management is what is actually appealing to investors here. So, and I guess we don't even have to speak for the account values here. It's an absolutely disgusting amount of capital to be made here. And I do believe this is actually within the prop firm. I wonder if I can. I'll read through this after. I actually haven't read through these pieces yet, but I do believe, based on what I know about his prop firm standing, I think he has about 2.3 million in prop firm capital, or 2 point something. So I'm assuming this is with prop firm regulated risk, meaning he has to stay within that 10% drawdown, which of course he did plentifully. And he also has to be aware of the 5% daily drawdown or any other rules that they have. But as a swing trader as well, he definitely takes a more passive approach. But overall, $400,000 gain on this capital, 2.2 million in assets under management. Fantastic return overall. His deposits are about 2 million. So I guess what I'm seeing here is overall he had $2 million in assets under management. And then net himself about that 388 minus interest, of course. But the thing to show here is mostly that he is not only beating the S&P 500 in this case or on par with it, but he's managing the drawdown to a point where it can appeal other investors or people that may want to invest or privately fund him. Obviously, with prop firms, they don't necessarily look into this fact, but when you look at something like the S&P and the historical returns on it, you can see obviously there's fantastic outliers here, 46%, 45%, but if you do tally this up, and obviously I've looked at it before, there's about 50 years in this span where there was zero or negative returns. And on top of that, there's years, for example, 1931, with a 50% nearly decrease on your capital, as well as years like 2008, where we had the financial crisis, more recent years like 2022, where we had the pandemic flash crash. All of these things kind of circle back to the idea I talked about, where number one, he's on par with the market and doing a fantastic job from an a return on asset based standpoint. But the other end of the spectrum is he's minimizing his risk drastically compared to something like the markets, where we can see these negative 40% or negative 20% within a year period. He's able to keep his drawdown ridiculously low while making the returns that something like the S&P may make. And based on past research I've done on him, he has had years where he's done significantly better. I've seen 40-50% years from him. I can't even tell you where I found the data from it. It could have been on Instagram years ago. But in general, just the idea that this is what makes a trader appealing to private investors is not only how much they're making in returns, which some of you, if you're based in the industry prop firm average, these expectations of 10% a month need to go out the window, because 27% And I've seen some traders fall in the range of 36%, 40% are fantastic returns within a year. But on the other end of the spectrum, a great job at minimizing the overall drawdown compared to something like the markets. So, of course, many of you guys know I invest heavily. I talk about my investment accounts all the time. And the reason why something like this is so appealing and so powerful is if you can present a track record like this to someone, even like myself, who has capital to throw into investments. I look at this and I see that number one, he's beat my returns on my stock portfolio within the last 3 years. So I have not made 27% returns on my stock portfolio in 3 years. However, I've taken drawdown periods on my portfolio much more than 2.77%, which to me, if I can get in contact with a person like this, obviously I don't know, I believe he runs a firm or whatever. Um, I haven't reached out to anyone like this, probably mostly because of simplicity standpoint. I like to set and forget my capital. Um, but if I were to go and take 100 grand, for example, and put it into something like this, as opposed to the S&P 500, you can kind of see the appeal for that and why so many investors are willing to go and invest or privately fund someone like this, or someone like yourselves in a few years when you have an established track record and consistency along these lines. But I think a lot of it does boil down to those expectations. We saw plenty months where this guy made no income at all. We also have seen, 2.7% drawdown. I don't know what he uses for risk, but obviously for some of us, that could easily be a 5 trade drawdown or losing streak, which I've taken myself in July, for example. But I think it's important, obviously, to understand from that standpoint, but also, kind of, let's see here. I don't know what this one is. I wanted to read some of the topics on the side there as well. Oh, he's just showing a live. So it was my FX book. He's just showing that it is live. But you can see here 33.4% gain. And I want to read some of these. So 4 months valuation phase, proceed to the initial 1 million. Okay, so first 6 months of trading, second 6 months of trading, 2 million. Max drawdown 7%, no daily drawdown. Okay. Max drawdown of 7% is extremely impressive as well. That's another thing. So I assumed it was a 10% drawdown rule because that seems to be the industry standard, but he kept his drawdown within 7%, which is fantastic, and as well as risking 1 to 1.5% per trade, which, is obviously on par with what most of us in this server do, and then 49 trades within this period of a year. And I think this is insane, but his worst trade of the year was negative $83.80. I can't even mathematically quite understand that. It almost seems like a break-even trade at that point on an account of his size. So maybe he does break even very aggressively. But his best trade being $56,000, which, let's see if I can do the math at the moment on the account here. I definitely did my math wrong, but I think it's about 4% gain on this account, which obviously is also relatively on par with some of the trades that we take, being 3%. I personally risk 2%. We're going to go over some of my trades in a little bit. But another thing to focus on is average trade length is 35 days, which is definitely a much larger scale than some of us operate on. But it circles back to that idea of the passiveness on the charts. You can imagine how passive he was able to trade while taking these returns. He actually preaches passiveness a lot, similar to myself, Sven, or Andre. But I think it's important to kind of look at traders like this and understand the realities of their track record comparative to, what you're seeing on the majority of social media, but also comparing that to other investment classes, and getting an understanding of, as you guys know, I am involved in real estate. It says 5.5% here. They actually adjust that average based on taxes and appreciation. But personally, real estate returns about 10.6%, which is just about on par with the markets. If you look at something like the S&P on average, which is about 10%, commercial real estate, very similar, which is 9.5%, and REITs, which is a real estate trust, is 11.3%. All of these things you can see are significantly outpaced by someone who does personal trading like us. And obviously your goal long term is to essentially minimize your drawdowns while beating these average returns. which is extremely doable and also circles back to that idea that you cannot be sitting here expecting consistent 5% months every single month. It's just not how trading or business in general works. I did get a DM this week talking about someone saying they feel like they wanted consistency within trading, and they were upset that they couldn't achieve, for example, 3% every single month. But then I took their data in their back testing, divided it by 12 months, and they were at 6% per month. But the issue was, in their mind, because it wasn't 3% in January, 3% in February, 3% in March, they were upset with their data and they weren't quite understanding the grand scheme of things. Where if they took their yearly value, which I think was roughly 42% returns, I forget what it was at the moment, and divide that by 12, they were actually beating that 3% per month mark that they expected or wanted. But because it wasn't every single month and they even had losing months in there, they were upset with the returns. And I think this is just something to preface, but also get out of the way, because I just want to drive it home that you cannot let your expectations throw off your actual performance and what you can get from these markets, because I promise if you continue to look at it from the wrong lens, you're going to continue to struggle for years and years. I did that myself. I already told two funny stories at the beginning of this. A third one, even, is when Andre and I were first starting out. I mentioned that 10K challenge I blew when I was first starting with the goofy 0.4% I had left to go. But the other end of the spectrum, once I met Andre, I think it was mine and Andre's second challenge that we took together. We went from taking 10K accounts to we felt like we had it all figured out. We were ready to completely blow it out of the water. So we each bought, I think I bought a 100K, he bought a 50K. This was in my broke days too. Like, I did not have the money to be throwing into 100K challenges like this. But, I went and did that anyways, saved up money from my weekend job back in high school, and went for the 100K. Andre went for the 50. And we got our asses absolutely kicked in this challenge, despite going into it with 100% expectations of winning, so much so that we went from 10K to 10xing the challenge evaluation size we were taking. And, I just say I've told three goofy stories. You guys are probably going to laugh at it, which feel free to do so, but it really is the realities of like how trading pans out. It's not going to be this clean and consistent journey. It's going to be something where you have these stupid setbacks and failures. You're going to feel down, but if you keep going and set the time frame at a realistic standard, like I said, it took me about 2.5 years or 3 years, including my retail journey, about 3 years to even find funding or consistency. And I'm not saying it'll take that long for you guys, because honestly, from what I see with the majority of you and the majority of stuff I see in direct messages, you guys are where I was at in 3 years after just, about 2 months, 3 months of knowing me or using a swing trading strategy, which is fantastic. But I just say it because obviously I've seen some messages upset in chat, or, missing winning trades. I get DMs a lot of people feeling down because the markets have been in a slower period. And let me go over some of my more recent trades. I'm in EU for some of you that didn't see that in chat that I was talking about at the moment. So I had basic general idea. I had the sweep on liquidity. I think someone actually mentioned this trade to me last webinar. They talked about taking this high versus this one. I don't really personally see a difference there. You could take either one. I typically take my range, the ultimate high of my range. I do see the argument because this swept liquidity as well. You could take that. And actually, if you did take that, you would have gotten tapped in as well. My brokerage, due to spread, I was able to get tapped into this here, despite it not hitting on TradingView. But I had the general run on liquidity with very high volume, which is one of the main things we want to focus on, is that very high volume sweep on liquidity, and then a very high volume move that breaks structural lows. Obviously, for some of you that also know, I had that EU buy last week, where price obviously didn't give a great reaction, didn't get me to my break even, and took a -1 on that position. So right now I'm break even on this one, just going to kind of see how that pans out. It might not even ultimately reach TP or break even before the weekend starts. And then I also had an AUD USD loss. This was few days ago. It was actually before my GBP AUD winner that we're going to take a look at. Same general idea. We had that consolidation area, which shows a lot of orders are stacked up here, and then a very impulsive run through that liquidity, followed by a significant break of structure. I labeled my fair value gap here as well. And then price kind of consolidated for a while. I still had my order pending. I had to adjust it a few times from here to here to here. But then eventually price ran through very high volume, took my stop loss, and that was a -1. On top of last week's -1. Looking for my water. Let me see. All right, it's not with me right now. But and then I had the USD JPY miss that I did go over last webinar. I talked about it. I know some of you had this high. I personally didn't like it just because of the lack of liquidity sweep, which is kind of why I dialed in more on this high. But obviously another mistrade as well. Price retraced, didn't quite get to my entry, and then ran TP. I actually go through some of these trades in my most recent YouTube video as well, if you guys want to check that out. But the same kind of standard where we had the very impulsive sweep of liquidity, and then a very impulsive break of structure to the downside, and then continued kind of trailing forward similar to AU, but didn't quite get my entry there, and then made it to TP without me. Then I had pound AUD, which was honestly a very, very clean setup in my opinion. Number one, the consolidation that we talk about plenty. You guys know I'm big on the idea of consolidation and how many orders rest below or above that range. So when we see consolidation occurring, we know that at this ultimate low and at this ultimate high is where the majority of liquidity rests. So when liquidity is taken at the lows of the range, now the majority of liquidity rests at the high. So we're going to see price kind of work its way up there, create that break of structure. I also know some people mentioned it wasn't a good enough break for them. Personally, when I saw this, I kind of agree. But when price worked its way back down, consolidated, and then broke above again, that was basically my indication to enter. So I set the order there. Price worked its way very aggressively back into my entry, tapped in. We made it to break even. Didn't quite get to my risk free. Didn't quite get to my break even. And then we ran to TP for a 6% gain on this trade. So obviously the 6% here, -2 on AU, -2 on EU, net 2% at the moment for the last 2 weeks, I believe. And then I have this one currently running at the moment, and it's just floating. And we'll see. I'll keep you guys updated, obviously, on what happens with this one. And then there was one person who did ask me to go over their data a bit in today's session, so I can do. They're actually not even here, but they can watch the recording back if they would like. Sorry, my voice is giving out. I've had like allergies for the last 3 weeks now. Here it is. So I'm going to be going over Marco's data here. He just very basically has losses and wins drawn in here, and then we'll take a look at the data after. So I've already kind of given him a breakdown in DMs already, but he did kind of ask to go over it in a webinar. So very basically, we have our structural points that he's marking out here. We have a lower high, lower low, lower high, lower low, and then price break structure to the upside here. I think this is a great trade. I don't see anything wrong with it. I like the sweep on liquidity. He has the impulsiveness or the fair value gap marked out when it comes to his break of structure. Enters at the 25% of the range, 75%, and then gets a -1 here. A lot of these trades are in a similar boat. The ones I did mention to him is, for example, ones like this, where if price is ranging sideways here and I'm very lost in structure, I think it's always better to avoid these trades and take them, especially when it's very kind of loose on what highs and lows over here create a structural range. So he's kind of making his own within the middle of the range. So I do think ones like these are very easy to avoid and just try to sit out of them if market price is completely sideways like this, because I found personally I lose more than win in positions like that. This one, another great example of a trade. Some of you may argue it's a weak break of structure. That's perfectly fine as long as it's followed his rules, but we have a sweep on liquidity, a break of structure of the lows, and another -1. Keep in mind we're looking at all losses right now too, so this is his winners are down here. Um, this one, once again, kind of related back to what I talked about before, where if you're unsure where you are within the market, the range of the market, one, you can either sit out of it, or two, you should definitely be cognizant of your overall structural swing points. Because we have this market high here, we grab liquidity at that high, he even has it marked out, and then we break structure to the downside here and has this overall low marked out. So for some of you, you may even have a short position here from this high to this low, entering at that 75% of the range. And if you did, you would not only be break even on it, but you might have even ended up hitting TP if I do remember this trade correctly. I believe I asked him actually for an image of the outcome on this one. But overall, I think it's better to be aware of your overall swing points that are occurring here when you are working within these ranges. Because yes, this is structure here, but I would say it's more internal compared to the swing points that he has marked out. So I do think not only is that avoidable, but I think there was even a possibility for a better setup within that area. This one, great trade as well. Very impulsive sweep on liquidity, consolidation area. We break structure to the upside, just a -1. So a lot of his losers, I did see the majority of them were pretty good. The only ones that I looked at are the ones I've kind of mentioned here, and this is another example of one where you're very kind of lost within price here and what's going on. All of this internal range structure, if you're lost like this, number one, sit out. Number two, if you really want to, you can look back at past price and kind of establish the range you're in, which for me, just based on this image, I see a run on liquidity here that's very impulsive. I see a break of structure to the upside here, and that means that this is your range high, this is your range low. And just from the basic understanding of structural ranges, we can assume that this will hold and this will be targeted. And you can kind of see that occurring here, despite how long and complex this pullback was. We tapped into the very low of this range and then made a very impulsive rally to the upside. So I do think trades like these are avoidable, and are something you should probably more likely than not sit out on for one of those two reasons, either the ranging price action or just getting a better understanding of the range and overall structure that you're working within. This one here as well, it's not a bad trade. I did say for me personally, it's a bit aggressive, especially to go counter trend with these very small ranges that occur here. But I don't see anything wrong with this. It still follows his rules. Very impulsive break, a good sweep on liquidity with the wick. And let's see. This one, another good example of one. I don't see anything wrong with it. I like the sweep on liquidity. It's just a nice wick low. We have a break of structure to the upside. Very strong break as well. And then a -1 on that one. This one, once again, kind of goes back to that idea of ranging when price is sideways like this. I honestly, and because this is a compilation of all his losses, it really does kind of boil down to show you how often I think these ranging or consolidating trades lose compared to when we take a look at his winners. We'll see how many examples where price is sideways does he win. And I think that's one of the very key ways. I guess it does come with a little bit of experience, but understanding that if price is sideways or has low volume, you don't really want to be entered in it or, trying to involve in price in any way you can. This one was a great trade. I saw this one as well. We have a great consolidation, run on liquidity, break a structure, plenty of fair value gaps on the way down. He marks them all. And then we tap in, get a slight reaction, but then we inevitably run through the highs. Once again, definitely a bit of a ranging area of price. This one, we have a nice sweep on liquidity, break a structure to the upside. I think this is a great loss. You can see we just barely wick his low and then start seeing the retracement to the upside. It's very common as well. You can actually kind of see that in my AU loss that I took, where we wicked that low and then started making that movement to the upside. And it kind of just is rooted in that general idea of the liquidity that's resting below this low. Let me make sure I'm not missing any questions. What's your YouTube? It's the Simple Markets channel is the one that I run. Sven runs his Sven Trades channel. And yeah, I can go over some of your trades, Lucas, as well if I have some time. What time is it? 10:43. Holy shit. Where am I going here? I got lost. Here we go. So we'll take a look at some of the winners now. And this is his data overall. So one thing I did mention to him about his data, he's definitely a bit more conservative when it comes to the number of trades taken. He only had about what is this, 25 plus it, so 38 trades on all pairs, which I guess isn't too low, but 40% win rate, 15 RR overall is fantastic. I even talked to him about the idea of, if necessary, he can increase his risk depending on the drawdown. I'd like to see an equity curve here. It gives me a little bit more knowledge on his drawdown management, because obviously seeing just images of winners and losers doesn't give me too much of an idea of how they panned out. For example, if he took all of these losses in a row, it would be detrimental to an account and blown, versus a little bit more realistic, obviously, is I could see a consistent equity curve increasing based on the data here. But 15 RR in a year is once again fantastic returns. Um, Obviously, there's a little bit of the picture missing here when it comes to drawdown management, but we'll look at some of the winners here. Same rules followed, where we have the general sweep on liquidity, plenty of fair value gaps, break a structure to the upside, taps in, and a great 3 risk to reward. Similar idea here. This one, I will say, does look a little bit more range bound, but I do really like the sweep of liquidity here. I really like the break of structure. Very, very impulsive. You can see the fair value gap here, as well as the weekend gap, which does happen fairly rare in foreign exchange. It's a JPY pair, so it does happen more commonly on JPY. But a nice wick into entry and a very impulsive move to the upside. This is a fantastic example of institutional involvement, a real underlying, I guess, piece of price that we're looking for is when your entry gets sniped like this and runs very impulsively the other way. This one, not bad again. Very close to break even here. On a live account, it may have been closer to BE, but I do know even some people might have taken this as a sweep of liquidity, break of structure, and entered here and taken a winner here as well. So there's actually two kind of scenarios where you could have seen a winning trade here, depending on how you looked at it. Both great setups. This one too, we have a nice wick sweep of liquidity. We have a break of structure to the downside. Very impulsively comes back to entry, but inevitably makes it to TP as well. 20, sorry, I was just calculating. So he has 9 times 3 is 27, plus this is so about 30% returns, and then obviously 15 of that goes to the loser, so that's where he gets his 15 RR. I was just kind of double checking his math here. Another great example of a very impulsive wick below, sweep on liquidity, break a structure to the upside, and price works its way very slowly back into that entry, then inevitably runs to TP. All of these winners look great. I think one of the main things I also look for when looking at trades is not only, a lot of people they ask me to look at their losses and give them advice on it. I think the other part of it is looking at the winning trades, and it's honestly probably a bigger piece because I've talked about it before, how detrimental it is to lose or miss winning trades. But when I look at the winning trades, one of the most important things for me is making sure they're consistent, rules wise, but also just from a standpoint of realistic expectations. None of these trades stand out where if I saw it on live, I would have been like, that's a disgusting trade, that's an ugly one, that's a bit off, etc. And I think that's very important because when you do get to a live chart, these winners should be jumping right out at you. And if they're not, maybe it's something you haven't seen in testing, but also it's more likely that you're going to miss more winning trades if in your back testing you're a lot more aggressive in taking those ugly ones versus when you get to a live account and obviously you might be a little more conservative because there's live capital on the line. You could be in an evaluation, whatever it may be. But overall, I do really like the data here. 10 wins, 15 losses, 3 risk to reward on all the wins with a 40% win rate is fantastic. 15 RR returns for the year overall, which, for someone like me, that's a 30% account gain when I risk 2% on my personal, which is fantastic too. So overall, the data looks great here. Let me just want to make sure I don't miss any questions. I can also look at yours, Luke. I can look at some of your, I know you mentioned these are your older ones, round 5 here. Let me make sure. So round 6 here. All right, less aggressive trades with larger ranges. Avoid big liquidity areas for your highs or lows. Strong momentum near the entry and a convincing break of structure. Skipped trades. Let me see here. It's kind of tough to tell because you don't draw your Fibonacci, but I do like where you're annotating liquidity on a lot of these skip trades. I think this is very, very important as well. And maybe it's something that came with my experience, but when you see these low and slow consolidation areas, and then they kind of break below a structural point in a range, it's very, very important to kind of understand fundamentally what we are doing as traders, especially smart money, is looking for institutional involvement. And when I see slow and low consolidation periods like this, with no strong wicks of liquidity sweeps or anything like that, these are the trades that I think if you can learn to avoid them, you are going to significantly increase your win rate overall because you're taking into account that fundamental idea of high volume, long, strong wicks of liquidity sweeps, all of these things that show the institutions are being involved within that market. What is this up here? ATR. I don't know what that is. But overall, I do like this one. Another great example. There's no strong liquidity sweep here, so it's very, very, I think personally, this is a fantastic way to avoid trades. You're showing the break of structure. All the other rules are met, the fair value gap. But yes, seeing a low like this with no wick, no liquidity sweep, in a very slow consolidating area is going to lead you to losses more than wins. Let's take a look at some of the trade breakdowns here. Overall profitable in the data, about 7 trades of data here, compared to, so we'll go back to that idea I talked about where the low, slow consolidating highs, I'm pretty sure this is actually the same exact entry that you avoided, which was the sell position here. And in avoiding that sell position, not only did you avoid getting your stop loss destroyed, but you can now see the comparative difference between this sweep on liquidity. We come right through the low very aggressively, these 2 very strong candles to break that high, showing the institutional involvement in the markets. Price works its way back down there. We tap in and then run the high soon after that. A great sweep on liquidity of these consolidation areas. I think this is a great picture perfect setup. Comparing that to some of these other ones, I also think this is a good setup. The liquidity I think is marked a bit odd here. I would more like the liquidity in this consolidation area. But I do like how aggressive this break of structure to the upside was. This, I think, is a solid trade. Once again, the liquidity sweep's a bit odd here, but I do like the aggression, the wick high, the break of structure, plenty of fair value here. This one here, not bad as well. It's not necessarily up my alley. I don't like to hold trades for too long. Not sure if this is a break even or not, actually. It looks it almost, but sometimes this is also another reason why I like the break-even rule is it keeps me from being in this ridiculous extended period of price. This one here also a bit good, but I do come back to that idea of the liquidity sweeps being a bit awkward here when they're very, very minuscule like this, and you see these 3 relative equal lows. You have to be aware that a lot of orders rest below here, which is more likely than not why we see price attracted to those areas. This is a great example of a liquidity sweep. So you can see, for example, you have it marked out here at this high, a very impulsive wick that goes through there and then breaks structure heavily, compared to the one we see here where price barely kind of reaches below that low, almost forming an equal low in this case, compared to that one we just looked at. Once again, I really like this setup as well. Despite the liquidity not being a range lower high, I like how impulsive and strong these 2 candles are. Shows very clear institutional involvement. So a solid loss to take there. And overall, equity curve wise, obviously not too much to go off of here, only 7 trades, but I do think this is a pretty solid period of trades that I'm seeing here. Definitely improvement from the other rounds I've looked at as well. Sorry, my voice is giving out here, guys. I'm just about ready to wrap up too. Would you take the trade if we had a big sweep before the push down? I'm assuming, honestly, without even looking at this, I can assume which one you were talking about. And my answer would most likely be yes, because if you're talking about a significant sweep that runs its consolidation area and then breaks down, I think it's a great trade. And I think it does a better job at showing what side of the market the institutions are involved in. Volume is really the key, in my opinion. If you can spot high volume in a market and see where the money is being invested, essentially, you're going to be on the right side of the market more times than not. compared to something like this where I see almost no volume, so it doesn't give me a very convincing high to put my stop loss at. And my voice is like giving out today. I've been sick for so long now. It's been like 3 weeks. I've had allergies and my throat's been acting up. Any other questions for me, Luke? I don't know if I'll be able to get through everything else because I do want to wrap up the recording around an hour usually. But is there any questions from anyone else? Or if people want me to look over their data in my next session or whatever, I can do that as well. Or Sven has his session on Monday if you guys want to ask him. But honestly, if I could give any advice, any takeaway, kind of circles back to the beginning of this webinar where I talked about having a bit of a more longer term focus on your trading journey. Treat your account as an asset, not as a active income that's going to explode you from $100 a month to $10,000 a month right away within your first year. Obviously, utilizing prop firms is something that can do something like that in the longer term. Yes, it is a weekly thing. So I do all my webinars on Friday, and Sven does all of his on Monday. So you can tune into either one of those. I'll always be at this time on Friday. I think Sven is always around, I want to say 2 p.m. my time, which I'm not sure what that is in his time. I'm Eastern Standard. But yeah, these are held every week. And I guess my advice really would be not to be too hard on yourself. That's another big one. I'm seeing people upset when they see 2 months of drawdown or 2 months of a slow market period when, we just looked at one of the top FTMO traders in the world having 3 months where he wasn't making any profit, as well as much lower returns than what I've even seen backtesting from a lot of you guys. I've seen plenty of backtesting results with 30-40% returns. You're already on a great track there. Of course, you want to subtract a little bit of those returns for when you get to a live market and for human error. But overall, a lot of you guys are at a position right now that took me 2.5 years, 3 years to even get to. So don't be so hard on yourself when it's, 3 months into a swing trading strategy and you're not funded and profitable right away. I think that should be all for this week. If I get no other questions in chat, I can probably wrap it up here. My voice is dying if you guys can't tell. Should have grabbed my water today. Yeah, no problem, guys. All right, so I'll probably wrap it up here then. Yeah, have a nice weekend. Thank you, Justin. You too, guys, and obviously enjoy your weekend. Stay safe, and I'll see you guys next week.